Welcome to CEO Money. I'm Michael Yorba. Thanks for joining with us. I've got Keith Schneider, Marketgauge, on the show with us today. Boy, Keith, do we live in exciting times or what?
Absolutely.
All right, you want to start talking about gold, right?
Yeah, I mean, what's interesting is by all measures, gold is now turned into an actual safe haven as the equities market gets crushed. So if you take a look at the chart that I have up here, it's a very, very straightforward analysis. The top chart is pure price. One of the things that you can see is that for the first time in really since the beginning of the year, or actually late winter, early spring, that we've now been above the 200-day moving average. And basically where we are right now is what we call an accumulation phase. So if we can hold this 200-day moving average, looks really good. As you know, we've discussed this a couple times on your show. We've been a big believer that gold is the place to go. Now, two other things. When we look at price action, that's not the whole picture. What we also like to look at is momentum. And I have here what I call is my real motion indicator, and that really takes a look at momentum. So one of the things that you can see is that we broke out early, right? This green line here is our 200-day of our real motion indicator, and the red is the current price. And as you can see, in November, we really broke out. But also what's interesting is you can see the momentum is very, very strong. And in fact, we're about to get a phase change where our 50-day of real motion is about to cross the 200 well in advance of price. So momentum is strong. In addition, what we also like to do is benchmark gold against the S&P. And this indicator right here on the bottom is our triple play indicator, which looks at price performance relative to the benchmark. And as you can see, gold is just accelerating to the upside. Now, what's interesting, this red line here is basically sort of the monthly moving average, and the black is the 6 month. And so what's happening here is everything is moving into a positive position, where our shorter term moving average is now moving above the longer term in terms of the ratio, right? So it's a moving average of the ratios, and we are trading well above both the 6 month and the monthly, and it's all in gear.
Tells me the volatility is going to increase, the trend is intact, and it could just take off from here.
Exactly.
Okay, got it. All right, the S&Ps?
Okay, let's take a look at the S&P here.
Now, am I looking at SPY? What are we looking at?
We're looking at SPY.
Got it.
And
oh.
Right, very ugly. New lows on the year. We're now down probably about 8 or 9% for the year. But worse than that is, we were up quite a bit on the year just in the beginning of September to late October. Mm-hmm. So one of the things I just want to point out at the moment is that the momentum indicators here worked really, really well. In fact, it was a very early warning. So one of the things you can see is our price and momentum sort of roared here. And as the market made a new high late summer and sort of peaked out in September, you can see the difference in momentum. So it's very important when you are looking at price action to understand that how momentum is operating and also price leadership. So since the S&P is benchmarked against the S&P or even against the world index, it's not showing any strength. So if in fact here we got a phase change, the 50-day crossed under the 200, that's a death cross, And when the market also starts to trade well under the 200-day moving average, that's significant. So 5% below means that you're in for some more rocky waters. So net, that's where you are. Now, one last thing before I leave here is I'm going to go to the my website for a second and just take a look at one other indicator. Yeah, that's in the tools section.
Okay.
But if you click on the sector analysis, one thing you can certainly see is that virtually all sectors now, even safety, is running into some issues. So there's very, very little place to hide. One of the concerns is the big move up in bonds, which was really dramatic, may have peaked out, and there's really no place to go at the moment. Now, finally, what I also want to do, just hang on for 1 second.
Sure, and let me bring up the bonds on my chart too. I follow the futures. A little bit of a bounce off of the what I've got is a longer-term 38.2% retracement level, but it's above, the futures are above all of the averages. My MACD is just going, it's at a 45-degree angle, which is very strong. Volume's up, open interest is up. Looks like everybody's leaving the stock market and they're going to bonds and they're going to gold. If they can't get executed on gold, then they just throw it in the bond market.
Right. So one thing to take a look at is in terms of just the oversold and overbought scenario. If you take a look right now, now this is not updated as in real time, but as of the close, this is looking at the McClellan oscillator, and the you can see it's starting to hit pretty oversold levels, but you're not quite there yet. You, in fact, in the beginning of the year, were more oversold on those market internals. So yet there is some more possibility on the downside. And if we go to sentiment, that's where it's looking a little bit more like it's getting extremely rich on the downside. And let me point to
what ETF, what's the symbol on the ETF you're looking at?
Well, in this particular case, all I'm looking at here is the S&P, and this particular chart on the bottom, or this graph on the bottom, looks at the number of stocks. This magenta line here, the number of stocks above the 10-day moving average, and at the moment, as of the close yesterday, and it's worse today, 98.4% of the stocks are under the 10-day moving average, and also about 84% are under the 200-day moving average. This is pretty damn extreme, and in terms of comparison, just going back over the last 10 years and before the financial crisis, that's the only time it was richer on the downside. So you're definitely hitting pretty broad extremes, but this is a very, very unusual scenario.
Here's my take on this, Keith. We're going into the Christmas holiday, New Year's Eve holiday season. Everybody has left the driver's seat, and this is happening now. So there's a lot of people that normally would be paying attention that are going to wake up Christmas morning, Wednesday-ish. You know, I mean, what do we got? Christmas Eve on Tuesday, right? Christmas morning on Wednesday, am I correct? I got my dates right?
I think so, yeah.
No, Christmas Eve is Monday, Christmas Day is Tuesday. They're going to wake up Wednesday to a potential bloodbath, and then they're going to panic.
Right. Well, one thing is that we haven't seen panic yet, and one way to really measure panic is looking at the VIX. right? And at the moment, what's interesting
VIX.
is you can see the VIX is starting to break out. It's definitely in a bull phase, right, where the 50 is above the 200. Here's the price. But what's interesting is, again, the panic back in the earlier part of the year was much greater. So it's not like we've had some sort of blow off.
Not yet.
Where we could say, you know what, it's gotten really crazy. So that's interesting. You've got this this balance between some of the market internals hitting some pretty oversold levels, but the other half of it, looking at sentiment, certainly is not at any extraordinary level, just even going back a year. So there you have that sort of balance at the moment.
Well, like Betty Davis said, buckle up, boys. It's going to be a bumpy ride.
Absolutely. And short-term approach, you need really good short-term tactical approach. What I like to do is use the opening ranges and the stacking of the floor trader pivots from the prior day and develop a bias out of that. So at this point, we have not had any signs of a bottom yet at all on a pure price and short-term tactical basis.
Got it. All right, Keith, thanks for being a guest on today's show. We will stay updated with you as soon as we can get you back on the show, and we'll see what happens next.
Good luck. Have a great weekend.
You too. All right, you've been watching CEO Money with Michael Yorba. Thanks for joining with us. All right, like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.